What's going on? My name is Joey, and I'm the founder of Universal CPA Review. Today we're going to talk about passive activity losses. So if you like this video, make sure to hit like, comment, and don't forget to subscribe.
Equivalents have a maturity of 3 months or less.
So now we're going to talk about passive activity losses. And one of the most compelling words in today's dictionary is the word passive, right? Everybody loves the idea of passive income, but what about passive losses, right? What if you participate in a business or an investment and it doesn't result in passive income? Instead, it results in passive losses. What? I didn't sign up for that. Well, it's true, and it's very possible. And that's what we're going to talk about right now. Okay, so there are two sides to this equation. We have how this impacts the individual and how this impacts the entity, right? This is typically income from a flow-through entity, which we'll learn about here in just a little bit when we get into our entity tax portion of all of this. On the individual side, we want to know if the taxpayer, in this case Eli, can pass this loss through and take the deduction on his individual tax return. Okay, so we have 4 very basic steps to this mental map. In order to take a passive loss deduction on the individual's tax return, they first need to clear 4 hurdles. And those are 4 steps that we need to know in our mental map. The good news is the rules are pretty similar, but there are some caveats that we need to be aware of. Okay, so we have hurdle number 1, which is going to be the taxpayer's tax basis hurdle. Then we have hurdle number 2, which is their at-risk basis. They need to then clear hurdle number 3, which is passive activity loss income, and hurdle number 4, which is excess business income. So this is how it all works. Let's say that Eli has invested in 3 flow-through entities, which are typically derived from business activities or rental activities in which the taxpayer does not materially participate on a regular basis. Okay, so let's say that Eli has 3 companies that he's invested in a passive way, aka no material participation, which we will define here in just a little bit as well. All right, so we have Panther LLC, we have Snake LLC, and Sloth LLC. All right, so he also runs a side hustle through the business where he makes a little extra cash managing the business's vending machines. But we're going to also circle back to that in a little bit when we get to hurdle number 3. I'm back. So again, in this video, we're talking specifically about tax basis. All right, so after this, there's also 3 more hurdles with the at-risk basis, with the passive activity income limitation, and then finally the excess business income limitation. All right, so if you're liking our visual learning approach, again, please make sure to smash that subscribe button. And if you really like the video, feel free to sign up for a trial with the link in the description below. Panther and Snake both had losses. Let's say Panther had $10,000 in losses and Snake had $20,000 in losses. So what Eli is trying to determine for his passive loss deduction is the aggregate of all passive activity losses and how much he could deduct on his individual tax return. So we're going to pull out that mental map because in order for Eli to take this as a deduction, he first needs to clear these 4 hurdles. All right, so the name of the game for Eli is maxing out the deduction, right? He has $30,000 in potential losses from this deduction. And these losses he wants to take on his individual tax return. Eli would love, love, love to take the entire $30,000, right? The bigger the deduction, the better it is for the taxpayer. But the IRS is saying, not so fast, Eli. We're going to need to stick these limitations on you because that's what we like to do. We like to make things complicated so CPAs can stay employed. So in trying to max out this potential deduction, Eli must first clear these 4 hurdles. All right, so we're going to think of these hurdles like Eli's 4 challenges he must first complete. All right, if he makes it to the end, he makes it to the land of economic prosperity, right? Because he wants to maximize his deductions and minimize his total taxable income. So the first hurdle, right, the first challenge that Eli needs to clear is the tax basis hurdle. Okay, so what is tax basis? This is the contributions made by an investor or a partner in a partnership. And when there are multiple flow-through entities, right, multiple streams of passive income, or in this case, passive losses, then tax basis is going to be the combined amount invested or contributed to that flow-through entity. Okay, so what is Eli's basis in these specific investments? This is not the $10,000 or $20,000 in losses. This is Eli's total initial contribution into Panther, Snake, and Sloth LLC. And that amount is going to be adjusted for whatever passive activity income occurred in the current year. Okay, so the concept of basis can be thought of like the balance sheet in that it is sort of like a bank account, right? So that bank account is getting adjusted all the time. All right, so Eli's initial contribution can be tax basis, but that is going to be adjusted for income, right? It's going to increase when there's income, reduced for deductions, reduced for losses, increased for additional contributions, decreased when there are distributions, and it's going to increase when debt increases, right? Cash is coming in, and will be decreased when debt decreases, right? That's going to be when the cash is going out the door, right? And keep in mind when it comes to debt, this is the taxpayer's share. And when we're thinking about tax basis specifically, this is basically going to include all debt. Okay, so this is going to be important when we get to hurdle number 2. But in short, for now, remember that this will include both recourse and non-recourse debt. Right, so if you're taking a look at your online banking at JP Morgan Chase first thing in the morning, right, maybe you see that initial cash balance in your bank account, and you see that it might have changed. Maybe you received money from a Venmo payment you received from your friend. Maybe your bank account went down from all the makeup you purchased last week at Sephora, right? Who knows? But the more important point here is that the taxpayer's basis will fluctuate based on the business's activity, just like your bank account balance will fluctuate based on the amount of cash that you received and the amount of cash you paid. Okay, so hurdle number 1 is a taxpayer's tax basis. So what does that mean? Well, let's remind ourselves, what is the ultimate question we're asking ourselves here? And that is, of Eli's $30,000 in combined potential losses, how much can he deduct? So the first thing we need to understand is, what is Eli's total combined basis across all 3 of these businesses? All right, so let's say that Eli's basis in Panther is $20,000. And let's say that his basis in Snake is $10,000. And his basis in Sloth is another $20,000. So his total combined basis is $50,000 for all 3 of these passive activities, and his total passive loss amount is $30,000. So the first hurdle is that he can only deduct up to the total amount of basis he has in these 3 entities. All right, so because he has $50,000 in basis across all of these 3 entities, he's going to clear this first hurdle. All right, and he's going to do so with flying colors. So of the potential $30,000 in passive losses, all $30,000 of it has cleared for the current year. Right, so all $30,000 of passive losses are still in play as Eli journeys towards the land of economic prosperity. All right, but what if there's a situation where the total passive losses exceeds Eli's combined tax basis? All right, so let's say in this case, the combination of basis across these 3 entities is $20,000. Right, Panther now has $10,000 in basis, and Snake and Sloth both have $5,000 each. So in this case, Eli's losses across these 3 entities exceeds the $20,000 in basis. So the IRS is saying, well, we're going to limit you, Eli, because you didn't even clear the first hurdle. So of the $30,000, so far you can only take $20,000 today. But what happens to the other $10,000 that exceeded his basis? That is going to be suspended and carried forward indefinitely until Eli has more tax basis to offset that remaining $10,000. Okay, so let's say that next year Panther had a better year and they had $10,000 in income. What that's going to do to Eli's basis is increase it by $10,000, right? Just like your bank account goes up when you deposit that Venmo. So now that $10,000 that was suspended from last year is carried forward. And like we said, he could take the rest now that he has more basis in year 2. Okay, because he now has more basis to make up for it. All right, and our last alternative scenario is what happens if Eli has this suspended basis from a prior year, right, that $10,000, but this year he doesn't have the opportunity to incur more income and therefore no opportunity to increase his basis to take the deduction because the business is sold or disposed of. So if the business is sold while suspended $10,000 in passive activity losses exist, right? We sold off Panther. Then what happens to Eli's $10,000 in excess losses over his basis from the prior year? So if we're talking about hurdle number 1, tax basis, in the event that the business is sold or disposed of while there is an excess of passive losses over prior year basis, then that amount is written off and will never be deductible. Never. All right, it's gone. Poof. Adios. Hasta mañana. All right, so this is specific to when we're talking about hurdle number 1. All right, so keep that in mind because when we get to the other hurdles, this might change just a little bit.